I call the remote hearing of the Capital Investment Committee for January 14th to order. This remote hearing is taking place in accordance to House Temporary Rules 10.01. It is being live streamed by the House Public Information Office. Today, we will hear from the Minnesota Management and Budget Office about the debt capacity of our state, the historic interest rates received in the August bond sale, and how Minnesota is viewed by the credit rating agencies. Special guest appearance may be we may have Commissioner Jim Showalter join us later on today. And as a reminder for our members to please mute yourself. And if you want to see recognition, use the raise hand function. And if for whatever reason you cannot use the raise hand function, please email recognize to Committee Administrator Jenny Nash and or Community Legislative Assistant Joe Linchesky. And now with that, Mr. Linchesky, the CELA will now call the roll.
Members, you may now unmute your phones when I call your name while the roll is taken. Representative Fu
Lee, present.
Representative Fu Lee, present. Representative Mary Murphy.
Murphy, present.
Representative Mary Murphy, present. Representative Dean Erdahl.
Present.
Representative Dean Erdahl, present. Representative Esther Abaje.
Abaje, present.
Representative Esther Abaje, present. Representative Kayla Berg.
Present.
Representative Kayla Berg, present. Representative Greg Davids.
Davids, present.
Representative Greg Davids, present. Representative Keith Frankie.
Present.
Representative Keith Frankie, present. Representative Mike Freiberg.
Present.
Representative Mike Freiberg, present. Representative Rick Hansen.
Hansen are present.
Representative Rick Hansen, present. Representative John Hewitt.
Present.
Representative John Hewitt, present. Representative Leon Lilly.
Lilly, present.
Representative Leon Lilly, present. Representative Eric Lucero.
Happy Thursday.
Representative Eric Lucero, present. Representative Rena Moran.
Present.
Representative Rena Moran, present. Representative Nels Pearson.
Pearson, present.
Representative Nels Pearson, present. Representative Donald Raleigh. Representative Donald Raleigh. Representative Jordan Rasmussen.
Present.
Representative Jordan Rasmussen, present. Representative Liz Ryer.
Ryer, present.
Representative Liz Ryer, present. Representative Nolan West.
Here.
Representative Nolan West, present. Representative Jay Zhang. Representative Jay Zhang. Representative Donald Raleigh. Members
Representative Raleigh, sorry, Mr. Linchesky. So Mr. Raleigh, Representative Raleigh is on. For some reason, we can't hear you, Representative Raleigh. And so the chair will note that Representative Raleigh is here, and I will keep the row open for other members who may have missed roll call. Mr. Linchesky did say that we do have quorum. And next on the agenda, we have the approval of minutes. I would like to ask if we have a member who knows. Yes, Representative Murphy.
Mr. Chair, I move approval of the minutes for January 12th.
All right, Representative Murphy moves approval of the minutes for January 12th. Any discussion? Hearing none, those in favor say aye.
Aye.
Those opposed say nay. The motion prevails and the minutes for January 12th are approved. The next item of the agenda is the August 2020 bond sale briefing from MMB Assistant Commissioner Jim Hassemer. Welcome, Commissioner Hassemer. Please proceed with your presentation.
Thank you, Mr. Chair, and good morning, and members of the committee. It's a pleasure to join you here this morning. I think the slide should be coming up on your screen, hopefully here in just a minute. Let's see. Commissioner Showalter did want to send his regards. He's actually testifying before Senate Finance Committee this morning, so he won't be able to join us today. But he wanted to say he looks forward to working with the committee throughout session. For the record, my name is Jennifer Hassemer. I'm Assistant Commissioner for Debt Management and Minnesota Management and Budget. Today, I'm going to present on the state's 2020 bond sale, our capital investment guidelines, and debt capacity. By way of a brief introduction, MMB's Debt Management Division is responsible for managing and ensuring ongoing compliance for the state's debt portfolio. We sell bonds authorized by the legislature and provide guidance on debt structures and use of proceeds. We also manage the state's relationship with outside bond counsel to get legal advice on various debt matters. Twice a year, we publish a debt capacity forecast in conjunction with the budget and economic forecast that reports on the current status of state debt obligations and debt capacity. I believe you all received a copy of the most recent November debt capacity forecast in your materials for today. Before walking you through some of the highlights from that report, I wanted to first give you an update on our bond sales from last year. So turning to the next slide, this graph shows the municipal bond market indices for 2019 and 2020. Interest rates had been trending down since the beginning of 2019 when the pandemic-induced recession hit last year. Interest rates spiked in March of 2020, and the municipal bond competitive sale market essentially froze for about 3 weeks. Various federal stimulus measures brought calm to the market, and rates moderated over the summer and remainder of the calendar year. Rates continue to remain at historically low levels. The absolute low point last year came in August. In fact, the dip that you can see on this graph happened to coincide with the date that we sold bonds last summer. Turning to the next slide. On August 11th, MMB sold 7 series of general obligation bonds totaling nearly $1.2 billion. Not only was this our largest single day bond sale ever, we also received the lowest interest rates ever. We never approached bond sales with an eye to timing the market, but we were certainly very fortunate with our plans last year. The sale raised about $500 million for new and ongoing capital projects, with interest rates ranging from 1.256% to 1.596% on new 20-year bonds. For comparison, the previous low interest rate was 2.06% just a year prior in 2019. We also took advantage of the low interest rate environment to refinance outstanding debt. Our refunding bonds saved the general fund $47.5 million and the trunk highway fund $57.5 million. The picture you can see on the right of this slide is just a picture of the cover of the official statement we published in connection with last year's bond sale. This is a statement, a detailed statement of the state's financial condition that we prepare for investors before each bond sale, so that investors have something to review as they weigh whether or not to buy state bonds. I believe you also received a copy of the full official statement in your packet for today for reference. Turning to the next slide, just for your situational awareness, MMB typically sells bonds in late summer every year. Our general obligation bond sales are usually held in early August, and then sales for any general fund-backed appropriation debt follows by October at the latest. So switching gears to the state's capital investment guidelines and flipping ahead to slide 7, I believe Mr. Lee provided a preliminary introduction at Tuesday's hearing, and I'll try to go into a little more detail for you today. The reason the state maintains guidelines is to have a comprehensive, consistent, and well-communicated set of policies to help guide decision-making, communicate policy goals, and demonstrate an ongoing commitment to long-term capital planning. The guidelines that I'll walk through in the next few slides are designed to be consistent with how the credit rating agencies rate our debt burden, allow comparison across states, and are inclusive of all tax-supported debt, not just general obligation bonds. Turning slides. The types of net tax-supported debt captured in our guidelines include all of the various obligations listed on this slide. General obligation bonds, both various purpose and trunk highway, state appropriation bonds, agency bonds payable from standing appropriations, lease purchase financings for real estate and equipment, and moral obligation debt. Turning slides, the state maintains 3 capital investment guidelines. Guideline number 1 states that total tax-supported principal outstanding, or bonds that have been sold, shall be 3.25% or less of state personal income. In the November debt capacity forecast, Guideline 1 measured at 2.27% of personal income. The debt measured in this calculation includes state general obligation bonds, state appropriation bonds, and debt supported by standing appropriations, such as for the University of Minnesota and Minnesota Housing Finance Agency, as well as lease purchase financing for real estate. Turning to slide 10, Guideline number 2 states that the total amount of tax-supported principal, including debt that has been sold and debt that has been authorized but is unsold, shall not exceed 6% of total state personal income. The debt that is measured in this guideline includes all debt included in Guideline number 1, including the authorized but unissued debt, plus moral obligations and lease purchase financing for equipment. In the November debt capacity forecast, Guideline 2 measured at 3.93%. And finally, turning to slide 11, Guideline number 3 states that at least 40% of general obligation debt shall mature within 5 years, and 70% shall mature within 10 years. Currently, 75% of the state's general obligation debt is scheduled to mature within 10 years. The Constitution limits general obligation bonds to a maximum 20-year term. So this rapid amortization allows new debt to continue to be authorized in the future, thus providing fiscal capacity to continue financing capital projects. Turning to slide 12, this is a table that is published in each debt capacity forecast and shows the details behind the capital investment guideline calculations. This slide actually just shows the top half of the report table, as it would be too hard to fit on one slide, and it lists all of the tax-supported debt factored into Guideline number 1. GO bonds, or general obligation bonds, are listed on the top 2 lines, and the different appropriation bonds are listed on all the lines below. Adding up the total principal outstanding in the first column shows that $7.8 billion is used in our calculation for Guideline number 1. The second column shows what has been authorized to date but remains unsold. Turning to the next slide, which is the bottom half of the report table, this shows how Guideline number 2 is calculated. All of the debt from the prior slide is added together with moral obligation debt and equipment leases. The sum of these figures is $13.5 billion, which is what is used for Guideline number 2 calculations. And finally, the data at the bottom of the slide reports the state personal income figure from the forecast and also restates the Guideline number 1 and number 2 percentages from the earlier slides. Slide 14 shows a historic look back at the guideline measurements over the last 10 years. The slight uptick you can see from 2020 to 2021 reflects the bonding bill that was just passed in October. And you can also see that the state has remained below the guideline limits as shown on this graph. So starting to transition to debt capacity, moving to slide 16. One thing to point out is that our debt capacity forecast calculations for Guidelines 1 and 2 reflect a point in time. They also only reflect debt that has been authorized by the legislature and do not factor in forecasted bonding bills. When the legislature authorizes new bonds, those obligations first appear in Guideline number 2, and then after the bonds are sold, they will also appear in Guideline number 1. When the legislature authorizes new bonds, the state does not sell the full authorization all at once. Bond sales usually occur over a 3 to 5 year period. And for each bond sale, MNB seeks to raise funds for approximately 1 year's worth of spending. We work with agencies on their cash flow needs and size our bond sales accordingly. But the debt capacity report also attempts to answer the question of how big future bonding bills can be under our guidelines. The budget and economic forecast assumes future bonding bills based on a rolling 10-year historic average. MMB updates these averages with each November forecast. In the latest forecast, future odd year bonding bills, including for 2021, are assumed at $240 million, and future even year bonding bills are assumed at $880 million. The general fund debt service costs for these assumed bonding bills are incorporated into the budget forecasts. Turning to slide 17, MMB also publishes a table that projects the maximum new bonding authorizations the legislature could pass in a given year, which you can see on this slide. The first line restates the forecasted sizes of future bonding bills, and the second line projects maximum bonding bill sizes. The goal for this table is to maximize the first opportunity the state would reach the limit in either Guideline 1 or 2. You can see that under our guidelines, the 2021 legislature could pass a $3.2 billion bonding bill, which would place us at the limit in Guideline number 1 in fiscal 24. This is in no way a recommendation to the legislature on the appropriate size of any bonding bill, but it is information for you as you weigh various spending priorities. The bottom line of the table shows the general fund impact, assuming the maximum new debt authorizations are actually passed into law. It's also important to note that the maximum figures are not just for general obligation bonds. Instead, this figure represents all the various types of debt that are picked up by our guidelines, including trunk highway bonds, appropriation bonds, and lease purchase financings. And turning to slide 18, final slide today, the chart here is another way to contextualize the state's debt obligations. Minnesota maintains a moderate debt burden relative to all 50 states. Moody's publishes an annual report that uses standardized data to compare states to one another. This slide shows data that aligns with our guideline number 1, outstanding tax-supported debt. You might notice that Moody's calculation varies slightly from our guideline number 1 calculation, but this is because Moody's uses a historical look back for personal income and outstanding debt, while MMB's report uses current data from the most recent forecast. Most states only move a few positions up or down in these relative rankings each year, if at all, and there's generally not a wholesale reshuffling of the deck. Minnesota has ranked in the middle of the pack for all 50 states for quite some time. And Mr. Chair, that concludes my prepared materials for today, but I would be happy to answer any questions from the committee.
Thank you, Commissioner Hassemer. And I do want to note for the record that Representative Jay Zhang is present in the committee. And so any members' discussion or any questions for the commissioner? Representative Jordan Rasmussen.
Thank you, Mr. Chair, and thank you, Assistant Commissioner, for the time and the presentation today. I was wondering, could you give any feedback that we're hearing from the rating agencies when we're meeting with them in terms of any concerns that they have about our future outlook that we should be thoughtful about?
Commissioner Hassemer.
Thank you, Mr. Chair and Representative. It's worth noting that the state is rated AAA by 2 of the 3 rating agencies, S&P and Fitch, and just 1 notch below AAA at AA1 by Moody's. The last year has certainly thrown everybody into trying to reevaluate the exact conditions that states are facing now and going into the future. The rating agencies are largely taking the long view that states are generally equipped with the tools needed to recover from the pandemic-induced recession. But there are lingering concerns in different sectors about different structural impacts to the budget and the economy. Many states that are heavily dependent on hospitality sector and the leisure sector are suffering the worst, and the rating agencies are paying attention to those states particularly hard. But generally, the rating agencies view Minnesota as having tools needed to manage through the recession.
Representative Rasmussen, follow up.
Mr. Chair, Assistant Commissioner, thank you for that. And the only follow-up I have is any mention on pensions and any concerns about that, or was that not a limit of focus?
Commissioner Hassemer.
Mr. Chair and Representative, the rating agencies are always focused on pensions. It is considered equivalent to a debt liability in their eyes. It is a long-term liability of the state. They are watching how market returns last year might impact the funded status of the various pension funds. The state did have a 4.2% return on its pension plans last year. It was not quite as bad as predicted in March and the early months of the recession. And that is something they will pay attention to over time, but there are no immediate concerns.
Representative Rasmussen, any follow-up?
No, thank you, Mr. Chair.
Thank you. For Commissioner, I have a question. So can you talk a little bit about the interest rate? Was this a historical low for us? And what can we expect if we were to pass a bonding bill this year for 2021?
Thank you, Mr. Chair. Yes, last summer's bond sale was truly a historic low. I don't think we expected rates that low, and we're very pleased to be able to deliver that to the state because it will result in long-term savings to the general fund. Rates have gone up just a little bit since our August sale, but they still are at very, very low historic levels. And they're projected to remain so for some time as the entire country comes out of the recession. Right now, we do plan on selling bonds again next August. That will be the first bond sale we hold for portions of the 2020 bonding bill. We're anticipating low rates, and we'll just continue to watch the market and any developments in the coming months.
Thank you, Commissioner. I see Representative Lilly have a question for you. Representative Lilly.
Thank you, Mr. Chair and Commissioner. So in this particular year, you feel that we could, based on the lower rates and such, we could probably do a solid bill this year. The capacity's there.
Commissioner Hassemer.
Thank you, Mr. Chair and Representative. The capacity is there under the guidelines. And as I mentioned, it will have a general fund impact above a bill above $240 million for this session. So that'll just be the challenge before all of you.
Thank you.
Representative Lilly.
Mr. Chair, I just more of a comment for the committee. I'm just going to use one example. As I've served on this committee for a bit, I'm out just taking up one example, like HEAPR, for example, for our college campuses, and I'm just always shocked that we are leaving them, our public facilities in really horrible condition. And so this seems to me to be an opportunity to really build out on that, and some of these projects and pick up with the rates low and take advantage of that. So it's mostly a comment, and I think when we get to HEAPR, I think some of the newer members will be really surprised how many of our college campuses, that's just one example. There's a lot of other areas in your budget, but just that one item, how short even though we, I think last year Chair Murphy's bill was strong with HEAPR, but still there's a lot, and in past years, but there's still a lot left on the table. Thank you.
Thank you, Representative Lilly, and we will make sure that we get the two-state system before us to let us know the incredible need that we have with HEAPR. And right next, I have Representative Erdahl for questions.
Thank you, and Ms. Hassemer. So you're saying $3.2 billion bill would be the limit. Once again, that was Representative Lilly, but I certainly Heaper. What is the capacity for the next year? Two. Well, what was that again?
Commissioner Hassemer.
Thank you, Mr. Chair. And just to clarify, Representative Erdahl, do you mean the maximum estimate for fiscal 22 then?
Representative Erdahl.
Mr. Chair, that is my question. Okay, if the capacity would be 3.2 this year, what would it be next year? Traditionally, the main bonding year.
Commissioner Hassemer.
Thank you, Mr. Chair, and for the clarification. In fiscal 22, the assumed bonding bill size is 880 million. And on the chart that we showed about the estimated maximums under our guidelines, this year would be 3.2 billion, and next year we had estimated 895 million, which would be above also the forecasted assumption.
Take it out now.
Okay.
So next year, Mr. Chairman.
So is that good?
Representative Erdahl.
So next year, when it actually is the bonding year, than this year, you're saying?
Commissioner Hassemer.
Mr. Chair and Representative, yes. The goal of the chart was really to give information to the current legislature as you weigh your priorities for this year. It wasn't trying to look ahead to next year quite yet, although we did project an estimated maximum for next year as well, if the 3.2 billion were to be authorized this year.
Representative Erdahl.
Thank you, Mr. Chair. And I guess it will remain to be seen happens this year. But again, traditionally, the first year is in terms of what we bond. But I guess we'll see how it all works out. But it's good to know what the capacities are. Thank you.
Thank you, Representative Erdahl. So I see Representative Rasmussen, but before I acknowledge him, are there any other members that have not raised their hand that wants to see recognition? All right, Representative Rasmussen.
Thank you, Mr. Chair. Commissioner, has your office done any analysis on what a bonding capacity could look like for the biennium without having an impact on our ratings that we have with the rating agencies? Or because I want to make sure that we understand kind of the difference between the maximums that you're calculating versus the guidelines versus something that would potentially result in a downgrade of our ratings.
Commissioner Hassemer.
Mr. Chair and Representative, thank you for the question. The rating agencies, they take a much more holistic view of the state when they do their ratings. In addition to debt and long-term obligations, they're also looking at the structural balance or structural budget picture, the economy picture, and general governance matters. So it's really different areas that they're looking at. The rating agencies put us consistently in categories of having a moderate debt burden, and usually that means that there's a range of the total debt obligations that could be out there that would keep us within the categories that they currently have us rated at. The bigger concern on their end would be if the state ever failed to make good on any of its debt obligations. That's when we would worry about any negative actions from the rating agencies.
Follow-up, Representative Rasmussen.
No, thank you, Mr. Chair.
Next, we have Representative Pearson.
Thank you, Mr. Chair and Assistant Commissioner. What is it that's keeping Moody's from getting us a AAA rating instead of the AA rating we have currently?
Commissioner Hassemer.
Mr. Chair and Representative, it's an excellent question. They have looked and they are still taking the long-term view backwards about some of the budget negotiations that resulted in government shutdowns in past years. And they see that there have been some idiosyncrasies and intractability in terms of getting to a balanced budget by the end of a biennium. So I think that is honestly one of the biggest factors that is holding them back at this point in time.
Any further questions for the commissioner members? All right, thank you, Commissioner. Seeing no other questions for the commissioner, you are free to go. And so members, just a highlight of what's up for next Tuesday. We will be having information only hearing on corrections changes to the fifth special session, House File 1, which is the October 2020 enacted bonding bill in Chapter 3. We will also hear from fiscal analyst, Mr. Andrew Lee, on the 2021 capital projects cancellation report. With that, members, this meeting is adjourned.